Hello everybody. In this video I'm going to explain the difference between an index and an ETF. Indices have no frictional cost to them that stores price. And what is frictional cost? Well, frictional cost is the broker fee that you pay, the FINRA and SEC fees that you pay when you sell a security. There's also expense ratio fee for ETFs and mutual funds, and then the bid-ask spread, and all of these things distort the price that you assumed for the shares. Well, an index doesn't work that way at all. An index is just a mathematical construct of securities defined by a set of rules. And an index can also represent things other than stocks. An index can represent the current temperature in Atlanta over a period of time. An index can represent the number of birds in the United States, things that don't make any sense, but that we can model them or estimate them somehow. However, in this case, an index is very defined, and it's defined by the largest 500 companies in the United States. They're traded on US exchanges, they're profitable companies, and then they're divided at the end by some constant, which you can get from the S&P 500 website. You can, or S&P website, sorry. You can also get it from other places on the web, and it's updated quarterly, I believe. I've actually imputed a divisor because share count is a bit tricky to attain completely accurate share counts for all 500 companies. And there are different classes of stock that are included in the S&P 500 index. And you can do this too. You can grab a list of the S&P 500 companies, get their tickers, either in Google Sheets or in Excel, grab their current market price, get the shares outstanding, multiply price times shares outstanding to get the market cap, or the total value of all of the shares together. So when you say Apple is a $2.1 trillion company, you're referring to this, the market cap of the company. So how does this relate to an index? Well, it's different than an ETF, because an ETF is just a sample. It's not the entire representation of all 500 companies in the S&P 500, for example. The market cap of the index itself is just the sum of all market cap, and there's two ways to compute it. You can just sum up the entire group of market cap here, or you can multiply price times shares outstanding for all of the companies and then sum them up together. That's another way to do it. The weight of the index is probably the most important part here. And what the weight says is how big is Apple compared to the total market cap. And we calculate this by dividing Apple's market cap by the market cap of the index, which is shown there. So since share count is a bit tricky to get, Google Sheets and Excel, both of the default functions will round share counts. I've just included a list from some other software that gets me a bit more accurate share count. And so when you do the market cap calculation, you get you have to get a divisor to get to the current S&P 500 value. This is pretty close to the current S&P 500 price. Last time I checked, just before the video, it was 4075.24, I believe. So that was the current price when I just checked before recording the video. And I got a pretty close number. My imputed divisor I actually calculated from yesterday's closing prices and yesterday's share count. So share counts might have changed overnight. Share counts can change during the day, and the divisor is meant to bring the market cap down to a reasonable, visible number that's much easier to work with and interpret. The divisor has no importance other than making it easier to read. The actual S&P 500 value is $35.9 trillion. Actually, almost 36 trillion since the 5 would round up. So this 5.94%. So if I actually create another column here, I can verify multiply 5.94 by the market cap, and I should get the market cap of the companies, and I have done this for all of them, as you can see instantly there. So let's move on to ETFs. ETFs do have frictional cost. Those frictional costs that I spoke of earlier. And while you can see that the weights here are going to be slightly different, I have brought up the Vanguard S&P 500 index holdings, and this is a list of all of the holdings and their values. And the proportions are very similar, 5.94 versus 6.02, 5.46 versus 5.24. And they're slightly different because Vanguard has to hold other things too, like cash, and they have liabilities themselves, the fund does. So the ETF version, and it doesn't matter what ETF, you could have SPY, for example, which is the ETF by State Street, and it's also pretty close. Also, I'm not exactly sure how recent this filing is, when this was last updated, probably yesterday after hours. But the weights are going to be very similar, and what the ETF seeks to do is track the index as closely as possible. And the difference is going to be called the tracking error, and we won't get into calculating this or anything. I just wanted to show and demonstrate that an index is actually fairly easy to calculate and do yourself, while an ETF is just a sample of the overall index set by parameters and rules. Thanks for watching, and if you have any questions, just leave them in the comments or send them my way, and I'll be happy to answer them. See you next time. Bye-bye.